Hello everyone, we are Rosa, Gelsomino and Associates, and today we're going to talk about the ESRS 1 general information. We divided our presentation in 6 main topics. The first one is an introduction about the ESRS. The second one, a background and rationale for the ESRS issuance. The third one, the key principles of the ESRS 1. The fourth one, it's a disclosure and reporting framework. The fifth, a future outlook and market impact. And the sixth, one conclusion. To begin the introduction, we're going to explain what is the ESRS. The ESRS, the European Sustainability Reporting Standards, set a structured framework for sustainability disclosures under the Corporate Sustainability Reporting Directive, CSRD. And why is it important? It's important due to the structured approach, defining how sustainability data should be presented. It ensures consistency, standardizing disclosures across different industries, enhances credibility with transparency, reducing greenwashing risks through audits. And for the last, due to the broad coverage, incorporating ESG, environmental, social, and governance factors holistically. Its objective is to ensure transparency, comparability, and reliability in corporate sustainability reporting across the European Union. In the next slide, we listed some key features, such as binding reporting standards for companies under the CSRD, the double materiality, where companies report both their impact on sustainability and financial risks, some audit requirements for limited assurance, reducing the greenwashing risks, as I said earlier. And for the last, the ESRS 1 covers ESG topics with detailed sector-specific guidelines. Okay, so in this slide, we made a table to talk about the difference between the NFRD and the CSRD. And the main differences are in the scope and the standardization of sustainability reports. The NFRD covered around 11,000 companies, while the CSRD covered 50,000, including SMEs in capital markets. In addition, the CSRD introduces clearer standards with the ESRS, reducing inconsistency in reporting. Another important point, it's about the greenwashing risk, because it's mandatory external audits, reducing those risks. And finally, the materially now considers financial impact as well as environmental and social impact. Okay, so to finish the introduction, we made a timeline showing some changes in the past few years. The shift began with the Paris Agreement in 2015, which laid the groundwork for those environmental regulations. 2 years later, in 2017, the ENFRD was enacted, mandating that large European companies disclose ESG information. However, discrepancies in corporate disclosures prompted further regulatory actions. The EU Sustainable Finance Action Plan, introduced in 2018, and the EU taxonomy aimed to channel capital towards sustainable investments and enhance transparency. The European Green Deal, unveiled 1 year later, outlined a roadmap for the EU to achieve climate neutrality by 2050, calling for stricter ESG regulations. By 2020, the European Commission began consultations on the CSRD, acknowledging the necessity for standardized ESG reporting to succeed the NFRD.
The issuance of the ESRS has been driven by two key factors: market demand and regulatory developments. From a market perspective, the last decade has highlighted the growing importance of environmental, social, and governance considerations. Investors, governments, and other stakeholders now prioritize the non-financial impacts of organizations and companies, and the ESG factors have become critical also for decision-making, risk assessment, and portfolio management. And for businesses, this represents an opportunity to ensure and enhance transparency and accountability, fostering a sustainable competitive advantage. On the regulatory front, the ESRS supports Europe's ambitious climate goals under the European Green Deal, aiming for net zero emissions by 2050. It also addresses the need for a strong mandatory European sustainability framework that aligns with international standards, while improving comparability across firms and industries. This foundation allows the European Financial Reporting Advisory Group, the EFRAG, to develop sector-specific standards. EFRAG plays a pivotal role by advising the European Commission on drafting the EFRAG plays a pivotal role by advising the European Commission on drafting ESRS through a rigorous and inclusive process. Stakeholders, including companies and industry groups, provide critical feedback to balance visibility of the project and also cost considerations. And despite its importance, challenges remain. For example, France and Germany recently called on Brussels to relax or ease certain reporting requirements, highlighting the complexities involved.
The third topic talks about the key principles of the ESRS1, and we separated three, as you can see in this slide, with the focus on the double materiality. This means that companies must assess sustainability from two different perspectives. The first one, the impact materiality, which looks at how the company affects the environment and the society and the population. And the other one is the financial materiality, which evaluates how sustainability risks impact the company finance performance. Another key aspect is the time horizons. The ESRS1 defines by short term until 1 year, the midterm from 1 year up to 5 years, and long term any period more than 5 years. Lastly, we have the value chain considerations, which emphasize both upstream packets, such as supplier sustainability and ethical resourcing, and the downstream impact, including product effects and waste management. The main takeaway of this slide here is that all these perspectives are interconnected and must be considered together for a comprehensive approach of sustainability.
Now I will talk about one of the main tools in ESRS, Disclosure and Reporting Framework. Under Disclosure and Reporting Framework, we have mandatory versus voluntary disclosure. Mandatory ESG disclosure requires companies to report on climate, social, and governance impact. Under a rebuttable presumption, meaning all topics are considered material unless proven otherwise with evidence. This ensures transparency and accountability. Voluntary disclosures allows companies to share additional ESG information, enhancing transparency and stakeholder trust. This flexibility enables businesses to highlight sustainability effort beyond compliance. Next, we have rebuttable presumption, which means all sustainability topics are presumed material unless companies have proven otherwise with evidence. Materiality assessment means it evaluates financial, which means impact on company, and impact on company's effect on society and environment. Materiality to determine reportable sustainability issues. Last but not least, we have qualitative reporting and quantitative reporting. Qualitative reporting provides a narrative context on sustainability policies, risk, and strategies, improvising stakeholders' confidence. Qualitative reporting delivers a measurable data-driven insight among sustainability performance, allowing for comparability.
So now coming to the challenges that companies might expect when dealing with the ESRS1 guidelines. One, for example, would be the data collection and quality, where it mainly refers to companies having to deal with the supplier and distributor side of their supply chain, making sure that also the suppliers and the distributors align with the ESRS1 guidelines. And if you're an apparel producer, for example, that can get very difficult if you have suppliers that produce, let's say, in Bangladesh or Vietnam, then it's almost impossible to control that. Another example would be legal and regulatory uncertainty, where basically the lawmakers still have to decide on a lot of guidelines, on rules that still haven't been finalized yet. So these kind of challenges are the ones that the companies have to deal with. Then for the opportunities that arise for companies with ESRS 1 would be, for example, transparency and trust. So that, for example, when it comes to investors, when it comes to clients, when it comes to employees, they have more transparency when it comes to their firm, to the company they buy from, the company they want to invest in, and therefore it facilitates, let's say, access to stakeholder satisfaction a lot more than it previously has been. Another example would be, for example, that implying ESR's one applying ESR's one guidelines, for example, when it comes to resource management, that companies might come up with new systems or new ways that use more energy efficient, that include more energy efficient processes, and therefore in the long term it could mean that the companies save a lot of money or resources when it comes to their inputs through more sustainable processes and day-to-day operations. And so now there are a couple of things that companies have to do in order to adapt to the upcoming challenges. One being, for example, that they have to upgrade their reporting systems. They probably have to employ a lot of people that are familiar with the new guidelines. They have to train people, and they have to capacity build in order to be able to sustain the new laws and guidelines. And another way they have to adapt, for example, would be to engage all their stakeholders, making sure that every stakeholder, primary, secondary, internal, external, know how the company wants to develop, what ways it wants to take, the overall direction it wants to head towards to. And yeah, because stakeholder expectations can also end up in conflicts at times. So, for example, a client might not have the same expectations as an investor, and so they have to make sure that they engage with the stakeholders and assure stakeholder satisfaction.
The Omnibus package is a big thing. Adopted by the European Commission on 26th of February 2025, the Omnibus package is a crucial turning point in sustainability reporting. According to Mario Draghi, one of Europe's most prominent economists, the EU must prioritize economic growth and industrial competitiveness over excessive rules on businesses. Also, Italy is aligning with this new European approach, as reaffirmed by our Prime Minister Giorgia Meloni during her speech for preparing for the European Council. The message is clear: Europe must remain competitive and reduce the gap in terms of innovation and economic growth with the US and China. For years, businesses had expressed their concerns over the cost and complexity of sustainability reporting. Also, Mario Draghi himself called the EU's current framework as a major source of regulatory burden, highlighting the lack of guidance and overlapping rules that make compliance so hard. The challenges in implementing CSRD constitute many barriers to scaling up and commercializing innovation, and the Omnibus package is the response to those challenges, to streamline and simplify sustainability reporting for the competitiveness of Europe in the global landscape. The Omnibus package is focused on narrowing down the scope of sustainability reporting, that is, small and medium enterprises will no longer have to comply, exempting approximately 80% of companies previously under the CSRD's mandate. It also extends reporting deadlines from 2026 to 2028 and 2029, so that 1.2 billion in immediate compliance costs are avoided across EU businesses that can be allocated into innovation in this crucial moment. It also reduces the amount of data point, which means that companies will report fewer ESG indicators, cutting administrative workload by 30%. Therefore, the Omnibus package will lower costs and administrative complexities for corporations, making it much easier to do business. In conclusion, sustainability reporting brings about both challenges and opportunities for Europe's global competitiveness. It enhances transparency, attracts sustainable investors, and positions Europe as a leader in the green economy. However, the high compliance costs and administrative burdens may hinder small and medium enterprises' growth and reduce business agility, as well as large corporations' growth and innovation capabilities. Therefore, balancing these factors will be a crucial matter for Europe's future and its competitiveness in the global outlook. Thank you so much for your attention and for the time you have dedicated to our presentation. Greetings from Gelsomino, Rosa and Associates Limited. See you to the next chapter.